Retail TV is brought to you by Varus Lee Investments, the largest retail investment advisory firm in the nation. Newmark Merrill is a shopping center owner, developer, and manager with a portfolio of 73 shopping centers with just over $1 billion in privately held assets. The firm does everything except enclosed malls, building single-tenant and shopping centers from 500 to 600,000 square feet in size. Their view is to go where the market takes them. In this segment, Newmark Merrill CEO and President Sandy Sigal talks about why the firm feels now is the time to pursue ground-up development.
Well, today I think the market is kind of a mixed bag. It's in transition. So, so this year we've done 3 acquisitions of existing centers, including a large shopping center in Colorado, which we're totally redoing. So that will be, those existing shopping centers, we're going to tear it down and reposition it. That came from a bank. We bought another shopping center that was a product of a bankruptcy, which we helped resolve, recapitalize, and now redeveloping that, and that's a remodel. And then we have another center that's an existing center up in Sacramento. That being said, we're for the first time seeing a lot of new tenant activity, so we're building more shopping centers from the ground up. And so this year we'll probably start 3 to 4 centers that will be totally ground up developments. Part of it is the banks have still not let go of a lot of assets that are problem assets. So, part of what still needs to be told is whether those banks are going to let those assets go at prices that are cheaper and whether replacement value is going to be a factor in whether it pays to do ground-up development. So I think that there's going to be some increase in new development simply because the tenants still have not grown for a period of time and now are finally starting to grow. But I think it's going to be a very slow uptick, not any sort of rapid increase. So what we're starting to see is more tenants being more concerned about both having long-term leases, because I think they're starting to see the market as in much shorter segments and the reliability of the market in much shorter segments. Secondly, I think they're starting to look at store size and store placement. So, Best Buy, just as one example, which has been very, very public, but there's others like it, have gone from having, larger stores or superstores to stores that are smaller to having smaller stores, much wider space than they used to have. So I think you're going to continue to see that trend accelerate. And so I think even the trend of this show is starting to see, shorter lease renewals and also some downsizing. There's kind of a dichotomy there. There's those who will take space, the major, financially strong retailers who will take a lot of space but very cheaply, okay, so they're taking advantage of economics. Or what you're finding you have to do is take larger space and break it into smaller units and then release it and deal with the cost of recreating new storefront and everything else. And I really think that you're seeing kind of things on both ends of it, but you're certainly not finding replacement tenants that fill those boxes like you used to. I think right now interest rates have kept this economy going, at least the shopping center economy. So, if interest rates stay at historical lows, I think it drives down your borrowing cost, right? Keeps rents affordable and allows very marginal projects to stay viable. If interest rates pick up or you see some inflation, I could see us kind of bouncing back down into a scenario where you have more shopping centers coming to the market, a further reduction in values. So I think we're seeing it kind of as a bumping along the bottom. We're very cautious in our outlook, but we think there's a big role to be advisor to companies to help them work through that and for banks to work through it. But I think next couple of years, I think we're very cautious. We get about 1,500 sales reports on a monthly basis based on our management portfolio and what we own. And I will tell you that notwithstanding the fact that values have gone up in shopping centers, the intrinsics, the sales levels have still been very anemic. I mean, we're up probably 7% off last year, which was probably about 3% over the prior year, which was probably the worst year in 10 years. So, you're still not seeing at a fundamental level a big increase in retail sales, except in the discounters and the very price conscious side of the market. So, we're keeping a close eye on the intrinsics. That's where we're focused, and then we'll make all our decisions from there.
Retail TV is brought to you by Varus Lee Investments, the largest retail investment advisory firm in the nation.